and you're in your third decade into it. So you're
Exactly.
clearly still going strong. But let's also double click on some of the macro factors that you're talking about, right? Give our audience a sense of where your head's at thinking about the world order right now, given that we're in the midst of geopolitical tensions, tariffs, wars. But somehow the markets just keep rallying up. Like the US hit all-time high yesterday, and this India also has had a great week last week. So where do you think? Obviously, this is a phase of maybe irrational exuberance before the music shock.
So I made a presentation in Delhi at the Outlook Money conference, and that was a presentation which again I had been thinking about it, and the title was that in my view, great bear markets are dead. And I analyzed all the great bear markets the last 100 years, and market history is about 100 years. Okay, from the 1920s, 30s up until now, organized market history. In that, we've had maybe 6, 7, 8 major bear. I'm talking global bear markets. And if you further segregate it, three have happened, 3 or 4 have happened because of inflation, oil prices. One has happened because of the GFC, which was 2008. One was the dot-com bubble. And maybe 1 or 2 others were, the Great Depression of 2930. Broadly speaking, inflation is the major problem. War is a minor one because that can lead to other downstream problems like oil. So the 1970s bear market that we saw in the US was because of the Arab oil crisis, the oil embargo, which spiked up prices and inflation and all that. Uh, and then, of course, we had COVID recently, which you can't even call a proper bear market, just lasted like a couple of months. GFC.com. Now, the world has gotten comfortable with the notion of the major reason for a bear market, which is inflation. Why? So, what is inflation? Inflation is the rate of change of prices.
Yeah.
Now, mathematically, we know it cannot keep continuing at the same pace, right? So, something goes from 100 to 120, you're saying 20% inflation. Now, again, you add another 20 to that, that's going to be, whatever, 16%. Then you keep adding 20, the price goes to 200, assuming certain periods have happened, that rate will have become 8%. What a central bank is going to say? Look, we killed inflation from 20% now to just 8%. And scroll out another couple of periods, you'll be down to 6%. Rate of change. That 220 is never becoming 100, which was the starting point of this thing. It's only the rate of change, which is all nonsense. So people say, oh, inflation is down. Yeah, but the prices are up from where the journey started. So everybody, at least most intelligent people, understand this is all a game of smoke and mirrors. Prices never come down. The rate of change comes down. And if you just wait out the period of inflation, optically it will come down by simple additional data points.
Yeah.
Unless you're talking, Argentina, Zimbabwe kind of 2000%, leave that. Those are again outliers. Civilized countries have civilized central banks and civilized policies, and you will never have runaway inflation for decades. At some point, because of the scrolling of data point, will come down to 5-6%. So markets have understood that don't get fussed about inflation. It's okay. Wait out a couple of quarters, 4 quarters, 6 quarters, 8 quarters. Let's not crash prices and lose money. We just then flatline for that period, which is why you see inflation no longer causes major lasting bear markets.
Right.
Now, then you come to GFC kind of bubble or a dot-com bubble. Now, regulatorily, GFC is probably not going to happen because, again, the Volcker rule and, limits on prop trading by banks and all that have been introduced as a result of that problem. Dot-com valuations were crazy. Now you don't see US tech trading at those valuations, not even close. They're all in their 20s, even they were down to the teens or 30s, but they don't
Yeah,
trade.
at a time you could buy Meta for 3x its earnings.
Exactly. So those bubble days are gone. Markets have again learned that we don't want to pay 500 times. It's just 100 years of history. Nobody understands this. Only 100 years, out of which I spent 35 years. Think about 37 years. Now, we are a learning organism as human beings. We will not repeat the same mistakes in aggregate as humanity. Pandemic, first time big shock. But the worst disaster in my living memory has been the pandemic. Everything shut down.
Absolutely.
The bear market lasted 1 month.
Yeah, there was such a quick
There was
recovery.
nothing. That's the point. So markets have realized that, look, none of these reasons are so structural so as to have long-term bear markets. What you will have are baby bear markets.
Okay.
4 months, 6 months, 1 year. And that too probably flatlining bear markets. Because again, leverage is the reason why you have big crashes. There are two reasons for big bear market crashes: bubble valuations, second, leverage in the system. A good company missing earnings or having slowing earnings doesn't fall 50%.
Yeah.
It just kind of goes into a long-term decline, or Asian Paints equivalents, correct? It will not fall 80% because there's no leverage. Leverage is where banks are overextended or where dot-coms are overextended. Those days we have dealt with. We are not going to repeat those mistakes again, or our infra companies in 2008. Once you remove the leverage in the bubble part of the market, even a bear market will not look like a brutal bear market because prices will not collapse. They will flatline. So if you look at India, on a point-to-point basis, we are flat for 1 year, approximately, give or take 4%, 1 year. Okay, US is also, you might have made a high, but you made a high earlier also. So you come here and you've gone back here. Over the period of 6-8 months' time, you're basically flat. In the same period, other markets are up on a tear.
We
US,
were just talking about
we were
Greece
talking
being
about
about 40%.
exactly. Greece is up. Poland has been a rocket market. South Africa, LATAM is in a stealth bull market. China, HSCI. So now India is flatlining, US is flatlining, other markets are up. India has not fallen on a 12-month basis, but it's not risen. Now ultimately, you can have an absolute bear market, you can have a relative bear market. So you lose relatively speaking. It's like an Asian Paints, it will not fall 80%, but it will not rise as much as the indexes will rise. So you're losing on a relative basis.
Or like HDFC that didn't move for 4
Exactly,
years.
that then move for 5 years.
Yeah.
So it's the same phenomenon. Stocks will not always fall in order for them to be in a bear market. Same with markets. They can flatline and you lose relative points by not being in others' growth stocks or growth markets. That's where India and the US are.